And so I feel like I've been thinking a lot about this existentially as a VC. What disappears first, you think, in kind of the growth stage, late stage venture capital? So you have three stages, really. You have the early stage, the pre-seed seed stuff, and you can maybe put A in that bucket. And then you have the A, B, and C stuff. And then you have kind of the late stage stuff, right? If AI is like this superhuman ability to create and do things, what do you think disappears?
And I think people have a lot of opinions that are changing. To answer your question about what happens in venture, my personal view is that late stage it shifts from, hey, we're going to help companies raise capital that they need to keep growing, to we're a liquidity firm, right? We're buying out earlier investors and taking a position for the next growth wave.
Hey everyone, welcome back to the Ignite podcast. Today we're thrilled to have Nik Talreja on Mike. He is the co-founder and CEO of Sydecar, an SPV administration platform that helps venture investors run SPVs by automating the messy back office, banking, compliance, reporting, and more. Fair disclosure, I am a customer and a big fan, so I'm glad to have Nik on the program, whose path runs through big law, venture building, and the weeds of private markets. Thanks for coming on, Nik.
Thanks for having me, Brian. Pleasure to be here.
Love to start with your origin story. How'd you get to where you're at?
It goes all the way back to childhood for me. I grew up in a family business. My parents started a business out of necessity just to make ends meet when I was about 10. And they couldn't afford daycare, so they threw me into the business. And I worked alongside them throughout school and even college. And seeing a business being built firsthand really planted a seed in me of wanting to do the same in my life at some point. I really enjoyed that journey. I saw my family move from poverty to having created some wealth for themselves. And I was really inspired by that. Long story short, you nailed it as far as my journey thereafter. I ended up getting a degree in finance, went to law school, worked in big law for a while. And that experience taught me a lot. Many things that I didn't want to learn, some things that I'm really grateful for now. In the journey of practicing law, I got to work with venture capitalists and founders and found myself really loving the founder journeys that I was associated with. I eventually started investing some capital of my own behind founders I really believed in. And that led to realizing I had a community of folks around me that wanted to invest in some of the same businesses. And I started to wear more of a venture capital hat. And that's how I met my co-founder, David. We started syndicating SPVs and we hit a bunch of pain points. At the time, there was a company called Assure Fund Admin that existed and AngelList. And they were the two vendors that we could choose from. And both had some flaws that we couldn't accept. One was in AngelList case that they had a marketplace model where we didn't want to take our LPs to a marketplace where they could be solicited for other deals. And Assure just seemed to have a really messy...
I wrote a whole article on this called AngelList for Breaking Up. I don't know if you crossed your radar when I removed myself from AngelList, 3 years ago.
Yeah, so you get it. Yeah.
Yeah, I mean, I was like, I had LPs reaching out and saying, hey, is this your fund? I just had AngelList reach out. Is this your fund? I'm like, no, that's not my fund. That's somebody else's fund. Oh, well, they reached out about it right through AngelList. And I'm like, oh, man. And that happened enough times. I was like, why am I helping AngelList?
Right. Yeah. So in a way that model's counter to the interests of some of their users. And, they're a great business. I know a lot of people there who are awesome. But, we didn't...
platform if you don't mind giving your LPs to a marketplace.
Exactly. So, we chose not to use them. And then that left us with another option that was very service oriented. And we couldn't accept the price point. So we looked to ourselves and we're like, hey, we're attorneys. We can get messy with the documentation. How hard can it be beyond that? So we started to roll around SPVs. We ran the math. We were able to get the cost down to something that was really acceptable for us. And lo and behold, through my law firm, we had a bunch of other VCs reach out and say, hey, I see that you're doing this for yourself. Can you do it for us too? And that turned into a business of its own. And Sydecar was born in late 2020. And officially early 21 is when we incorporated. And the rest is history.
I mean, that was the heyday of SPVs. 2021 is when I was getting into it. Like, I think I did my first SPV in mid 2020 AngelList. And yeah, that was the heyday.
Yeah, that was good times. Make hay while the sun shines.
That a little bit, right? It feels like 2026 is feeling a little like 20. It's not as frothy as 21, but it feels like we're kind of back a little bit.
Yeah, it kind of feels like it. It feels different this time though. It feels a little bit more concrete.
Yeah. These companies actually have revenue. I'm curious as a customer. I mean, one of the reasons I chose you guys, and I've run, like I said before we started recording, dozens of SPVs with you guys. So I was excited to do the pod. Really, how are you able to get the cost so low? You guys are for the quality level of the platform, which is very high. you guys have that, 4,500 price point, and it scales with the money that you raise. But how are you guys able to get it so low? Because everybody else is like 10K, 15, 20K.
Right. Yeah. It all comes down to automation. And on the lower end, candidly, accepting a slightly lower margin to enable a market to exist that we want to grow with. But we make the math work through automation. So everything from entity creation to funds flow, record keeping and accounting and tax is streamlined. So at that $4,500 price point, we're able to still get a decent margin by basically automating every part of that workflow so that our cost is ultimately driven by the support you get, not anything else along that journey. Like you mentioned, support is a big part of the value prop and service that we offer. It has to reach a really high standard for us to have a right to exist. And we're committed to primarily serving you, right? Whether it's through software or whatever you may need, you don't really care necessarily. You just want your LPs to have a good experience, right? So that's paramount for us.
Yeah, and I'll say as a customer, your guys' service is exemplary. I mean, it's very, very helpful, very knowledgeable, always there. I can ping the operations at Sidecar and get a response very quickly. I mean, how are you guys maintaining that level of customer service?
It starts with our values, and there's an unspoken value that customers are the MVP, right? We don't need to write that in our values for that to be true. It's kind of like a baseline of like, that is what Sidecar is about. I think for me, started in childhood when I saw my family start this business. My parents would tell me when I was a kid, like, we imported gemstones and other sort of jewelry related things from India and China, and then sold it to jewelry designers in LA who would then basically take our materials and make fine jewelry out of it.
Okay. Import, export.
Exactly. Just basic trade. But my parents would teach me as a kid, just to keep it simple, like treat our customers like guests. Like as if they were coming to our home, how would you treat someone that's a guest? And I was like, oh, that's pretty simple. I get that. And that value stuck with me to the point of like, we tirelessly tried to meet expectations or exceed expectations in the early days, even when the software wasn't where it needed to be. And that's still something that we take very seriously today, is that you have to have a good experience, right? Regardless of everything else here. And I think because of that, everything on the customer experience team is balanced against metrics that prove that you are having a good experience, right? Those are like the paramount metrics we track.
Yeah, that's the what is the North Star metric at a company like Sidecar? What's the thing that like when that's going up and to the right, you're happy?
Yeah, so good question. We're always asking ourselves these questions. Of course, revenue matters. We're a venture-backed company. We need to keep growing. But if we had to think about one metric that meant we were doing things well, I would distill it down to the touch points per customer to get a deal closed. Right. So if we can minimize that over time, it means that you're able to get your job done either by getting really comprehensive support from us in simpler, easier to understand answers, or the software is working for you really well. Yeah. And both of those point to we're doing a good job for you.
Touch points to close.
Yeah.
I like that. Yeah. And you guys do a really good job of that. What I like about it is you give us enough rope, but not enough to hang ourselves with as GPs. Because sometimes I'll be doing something and they're like, yeah, you can't do that, But yeah, it has a lot more flexibility than AngelList. Like, where do you kind of draw that line with compliance and regulation but also having the guardrails?
For sure. There's one line we draw clearly. It's like, we're not your law firm. We're not your counsel. So we try to educate you as much as we can through the product experience and then point you to education when you need it outside of Sidecar. The other place is we don't act as an advisor in your deals. We don't shop anything to your LPs. We want to enable you to do your job as an advisor, right? So within that construct, we can offer more customization and flexibility. Now, in some cases, you might be doing something that will force you to have to register as an investment advisor. We make that clear to you, like, hey, just FYI, you should talk to counsel about that. But we generally don't want to inhibit you from doing anything you want to do on the platform. So I think the line keeps moving out as far as what we offer on customization.
Yeah. And then you guys, I think, have recently pulled away from running funds. Maybe you could talk about like SPVs versus funds and kind of how the business is evolving.
Yeah, great call out. Earlier this year, we made the hard decision to stop supporting Fund Plus as a product and pass that business on to a couple partners that we have a lot of faith in. The reason for that is when we think about our right to win and we think about the broader private market that we participate in and serve, we kind of see our right to win as building out SPVs and other turnkey structures and automating that to the nth degree so that the price point to transact keeps going down. And when we think about that value proposition, it doesn't necessarily correlate with building a full life cycle fund services business for venture capital. that's what we landed at discovering.
Yeah.
If that's a completely different business and we had to choose two, which would we choose? We want to own certain types of structures for the entire private market ecosystem. And that's what made it clear to us that Fund Plus for that to be successful, we'd have to eventually scale in customization, support, investor reporting and services, more customer support, more people. And that's not something we wanted to do. Instead, we want to automate as much as possible around a few structures that everyone can come to us for, including potential competitors had we gone down the fund services route. So when we talk about AngelList and Carta today, we might think of them as a competitor, but I think about them more as potential partners and maybe even customers of the SPV product in the future.
Yeah. Yeah. One reason I didn't choose you guys for the fund, and you can tell me why this is a thing, but we're a very high volume investor. We're doing 150 in funds 2 and 3, right? And so when I priced it out, I was like, oh, with 150 positions on Sidecar and the Fund Plus, it's going to actually cost more than just going with Decile, which is what I use. I went through VC Lab. Yeah. So that was just like a little context. Who is like the leading fund provider in your mind? Like, who do you kind of look up to on the fund side of things where you're like, we don't run funds anymore, but you should go talk to, and you can name 3 names if you want. Like out there's Carta, of course, right? You got Aduro, you got AngelList, obviously runs funds. Like, who do you like go, okay, who would you send your guests to? Self really, because I'm about to choose another fund admin for another fund.
Yeah, I think it really depends on what you're trying to accomplish. If you're building out a multi-stage fund business, right, where you want to stick with the fund business and scale into, let's say, $500 million of AUM over some period of time, I think that Carta and Aduro do a pretty good job. I think Carta's gotten a pretty bad reputation, but they've solved for it by hiring. I think they've solved for a lot of stuff internally, and they have a pretty stable platform. I think Aduro's great as far as being a bit more of a traditional fund admin, and I think you know what you're getting there. Pricing is probably similar. If you're willing to work with more of the emerging company side of the equation, we actually partnered with a company called Zyve based in Austin that's building out a really cool product.
Actually. Yeah.
Oh, you are? Oh,
yeah,
cool. Awesome. Yeah. I put an angel check
on the podcast. Yeah, but he will be eventually.
Yeah, I'm an angel in Zyve as well. And, we partner with them for the Fund Plus transition. Outside of that, if you want a more of a manual but predictable, reliable, always will be there to answer questions type of fund admin, Standish has a pretty good reputation, but they're very expensive. NAV has a pretty good reputation. They're a bit more cost effective. So it really depends on what you're looking for. So high touch, Standish, NAV.
I almost have to have an investor, and that way I can tell my LPs, like, yeah, we're an investor in this agentic fund admin company, and we're using it.
Exactly.
Cool. So when you guys set out to solve this market, right, the SPV side of things, what were kind of the 2 or 3 concrete problems that you had to solve, no matter what?
One, well, I'll think about this from a couple of different angles. One is the value proposition has to be really strong, right? So we have to be able to do a job for our customers that is trustworthy and credible at a very attractive price point, so that you can run a $50,000 SPV and still make it make sense from a fee standpoint. 2, we have to be able to make the math work and the service work over the service term, right, which is 10 years. And that includes a lot of tax filings. So we need to automate tax, right, to make that make sense and understand the tax regulation and the impact of different types of assets and how that might change our cost to serve our SPVs. The third is flexibility. So we've taken a standardized approach to creating what we do, but we know that our customers will constantly want to push us in new directions, and we'll have business pull that might take us down like a complex carry structure type of waterfall, right? So how do we build a infra business that is scalable to accommodate more customization over time without overthinking it in the early days? Yeah. That was a real challenge that we figured out in year 2, right? And had to kind of reinvent ourselves.
Yeah. I was trying out Capital Co. Shout out to Brian over there, and it was so advanced. Like, I got into the platform and it was just like, I could like that was a platform that has so many knobs and dials. I couldn't even figure out what to do, like it was very advanced. It was very, very awesome platform. But I was like, I feel like I don't know what I'm doing here as a solo GP that doesn't have a lot of time to sit there and just kind of like move the dials and knobs. I just need to kind of collect the money and wire the money, just do the job for me. People don't, I don't know. Like, how do you think about that? Like, people don't want the drill. They want the hole in the wall.
I think people want to keep it simple, right? And get the job done and ultimately just make sure their LPs are taken care of, right?
What's changing besides, redoubling your efforts on SPVs? What's going on in the private markets today? What are you kind of seeing out there?
Secondaries are a wave.
Secondaries, yeah.
a big wave, a lot of deals getting done in 20 or so names.
Right.
We're seeing that institutional investors have an increasing appetite for direct deals versus just backing funds, which I think is interesting. And it's not just venture type deals. It's even more mature PE style companies that they want to invest in directly.
Yeah.
Or assets they find where they want to like create like a franchise business or whatever, right? Just somewhere. But it tends to be more of a direct style offering. Retailization.
The cyclicality of the business, right? Because you're gonna, 26 is gonna be a great year for you. It's a great year for me, right? I'm seeing it in my business, and it's easier to raise money than it's been in 4 or 5 years. I raised my first fund off AngelList in 22, 23. It was a slog, and now I feel like I can raise money just no problem. How do you deal with that? Do you have to like escrow some money when I close an SPV and it's like $10,000 to Sidecar? Do you kind of book all that revenue, or do you sort of like accrue it? You have to accrue it over the time, the length of the SPV, I would imagine, right?
That's correct. Yeah, we accrue
out the business a little bit.
A large portion is accrued up front because that's tied to our direct costs up front.
Yeah.
But then there's a portion that's accrued over the service term. Private markets are cyclical, but we're in it for the long haul. We believe that the CAGR of private markets will continue to be healthy for the next 20, 30 years. So despite any cyclicality in the next couple of years, we want to be around, which means, hey, we got to prepare ourselves from like a margin standpoint, from a cash standpoint, to make sure we can get through any storms and make hay while the sun shines. So we have a healthy balance sheet. We were cash flow positive last year. We're cash flow positive this year, I think, so far by a hair. Maybe not. I'm not sure. That's not the intention, but like we have a very healthy balance sheet while we grow. So that helps. Our economics, our margins are healthy. So we want to make sure that stays that way.
Yeah. So there's probably lots of VCs listening that have never run an SPV, because I hear from them all the time. And maybe they're angels, maybe they're VCs. They'll ask me, they'll say, hey, what should I use? I'm like, I use Sidecar. Here's the link. What would you say to them, like getting started? What should they know about getting to this business that you wish you knew when you started?
A couple things. Timelines are always a moving target. I think on the one hand, you're balancing a timeline with the founder that's like, I need your money tomorrow, when it may not really be tomorrow. On the other side, you're dealing with LPs that,
we got to close on Friday. Okay, great. Yeah,
exactly.
Friday. Yeah, sounds good. I'll check in with you on Friday. Friday comes.
Yeah.
I'm going to need another 5 days. Okay, 5 days. Okay, yeah, 5 days. This happens all the time in deals. Yeah.
Exactly, right? Founder says need the money by Friday, and you ask when the deal closed 3 weeks later. Happens all the time. Not to say that you should be the last check-in, because that would be terrible, but like,
right, you don't want to get pushed on a deal. Yeah.
Yeah, you need to massage that timeline with the founder so that you have enough time to coordinate with your LPs, who you don't want to pressure to like fund tomorrow if they haven't had time to think about something.
Right.
So you kind of have to balance these like timeline expectations on both sides, right? And increase the pressure on the LPs to wire and take action as is necessary, but also massage the founder relationship to make sure you have enough time to like not pressure your LPs. I think that's something I wish I knew. And at times coordination around that was really hard in the early days for us. The other thing is, this is me kind of wearing the lawyer hat. There are a lot of regulatory issues in being a manager, right? There are duties that you have as an advisor. You got to take that stuff seriously, right? So learn about it. Learn what it means to have fiduciary duties. And also learn about how, as a VC, you're typically in this exempt reporting advisor land where you don't have to register as an investment advisor and honor a bunch of compliance obligations. That is only true if you primarily invest in private company securities directly, where you're buying those shares in the company. If you do a bunch of secondary stuff, and specifically if you have like a single SPV that buys, let's say, a secondary asset, that could put you on this path to have to register as an investment advisor at some point. Now, that point is when you cross 150 million in AUM, so you may not think that's coming anytime soon, but that's measured at current value, market value. So let's say you do invest in a kick-ass company that's now worth like $50 billion, you might get there, right? So just know what you're signing up for from a regulatory standpoint.
Yeah, and there is a regulatory drag. I've already talked to my counsel about this, actually, because I'm definitely going to cross that threshold. Definitely have a lot of SPV secondaries on the cap table here at Team Ignite. So yeah, I'm going to have to pretty much, when I cross that 150 as an RA, yeah, it's going to happen.
Yeah, either register or partner and find a way for someone to take that business in a way and kind of like return economics to you. There are different ways to massage it, but
that's a good idea.
Lawyers don't like to get too creative, right? So you kind of have to figure it out earlier and make sure you have a plan.
That's really good advice. What do you see is the biggest misconception emerging managers have about running SPVs, compliance, and fund structure generally?
Biggest misconception? I think there's still a good group of fund managers that don't think that SPVs should be a meaningful part of their business. Like they think that the fund should be the primary mechanism for how they run their business. And I think that this is my hot take. I think that SPVs become a primary mechanism for deploying capital as far as measuring by dollars deployed.
Percentage. I mean, do you know that stat, like of, the 100 billion or so in venture capital every year? Like, how much is sitting in SPVs? I wonder. It's got to be a pretty big percentage.
I'm sure I wish I knew. It's actually a really good figure for us to chase down, but it's got to be sizable. And I think it's growing.
Probably tens of billions. I mean, because you think about all the liquidity events, all these like cap table funds, all these SPVs, all these follow-on rounds, all these pro ratas floating around. It's got to be a pretty big number.
Right. Because look, if you have institutional LPs that are saying, hey, we want to do more direct stuff, right? How do they do that? Through SPVs. That even triggers like the top 10 VCs by AUM to have to think about an SPV strategy. And we hear from some of them, which is super interesting.
Right. Yeah. And some of them run their own SPVs, right? They have their own like legal teams and they do that and they're big enough to do that.
And some of these deals where you may have a pro rata share in like an Anthropic raise, right? Or whatever it may be. Can you really fulfill that with just the fund? Probably not, but there's tons of appetite.
Or $25 million pro rata to fill, like, or you're out of reserves in your fund, or these are great problems to have. I wish I had those problems. Maybe 5 or 10 years from now, hopefully we'll have some of those problems. But what about you personally? I mean, I would find it hard to pull back from investing in startups. Have you pulled back at all to run Sidecar? Or are you still were you running funds before? Are you still running SPVs yourself? Are you a customer of your own platform?
All of the above, except we didn't start a true GPLP fund. We had an ambition to do so, and then COVID hit, and we switched to an SPV strategy in 2020, which is what led to Sidecar. I wish I had more time to invest, but building a business is like all encompassing. So, I spent a lot of my time thinking about how to optimize our business and add great people to our team. I do still write checks, but I don't syndicate SPVs as much as I used to.
Right. Yeah, I would find it hard. I mean, in a way, being a VC, and backing 100, we did 131 investments last year in 2025. So we're very high volume. And I just love meeting founders and backing their crazy ideas and talking to them on the podcast and stuff. I'd find it hard to like really just go work on something for 10 years. But I'm glad there's people like you doing it, because this is like a tool that the industry needs. Platform like Sidecar that's not AngelList, that's affordable and automated. And so thank you for that work. We need that. And from all the GPs out there, thank you.
Well, thank you for trusting us and giving us a reason to exist and do good work. But we still have a long road ahead, man. We're still early. Yeah. It still feels like, it feels like we're kind of...
just raised your Series A last year, right?
When was it? Yeah, a year and change ago. Yeah, that's right. Yeah. Series A. And yeah, I think we're probably pulling in Series B metrics now. We might raise a Series B, or I don't even know if if we'll need the cash. I think we can scale this business to a really healthy spot without raising more potentially.
Yeah. How do you think about that for the founders listening? Because you've kind of gotten a product market fit. Everything's frothy right now. Business is going great, right? You're cash flow positive. Do you go raise a massive Series B and just try to go tackle the market? Or does it really, do you need to even, right? Like, because at this point, if you're cash flow positive, can you just take the cash flow and reinvest in the business? How are you thinking through? That's a great problem to have.
Yeah, I think we're in a unique position given our business that we collect a good amount of cash upfront in our business. So I don't think like my answer here can apply to every founder. But if you are cash flow positive as a business and you have a healthy balance sheet, I think it behooves you to think about things like dilution for your team, right? Against a potential raise.
The whole cap table, including your employees. Right?
Exactly,
including
right?
Yourself.
Raising may still be the right answer. I mean, if you have access to capital and you can raise on really great terms, it's hard to say no to that. But you're signing up for a new set of expectations and potentially some dilution that may be at odds with building a business in a really healthy, stable way. And I think that's something that most founders don't really think about as much, is like, hey, what does it take to build like a legacy business over a decade versus just like a flash in the pan type of business that may reach some astronomical valuation in 2 years or not and then fail. We're in the financial services. Like, we make a commitment to you, which means like, I'm not trying to like triple this business next year if it means that we can't honor a commitment to you at a level of quality that we made to you 2 years ago.
Yeah, that totally makes sense. I think it's tricky, right? Because if you go raise 20 or 30, let's call it, on a Series B, and it might even be more than that for you guys. You're going to take the 20% dilution. And then the question is like, okay, if I have tens of millions of dollars, does it help me fulfill my promise to the customers and move faster? And if it doesn't like increase that ability to acquire customers and serve them and grow fast, then, it yeah, I don't think it's warranted.
And it's getting easier to build, right? It's getting
Yeah.
a little bit less expensive to deploy new features. So
Yeah.
that's
Have you kind
another.
of felt that as you've kind of been doing this now for 5+ years? Are you kind of feeling that in the organization? Well, you hear it a lot on the podcasts out there and stuff, that it's just, you're just able to deliver product much faster.
Yes. So funny enough, we have this thing called Side Star Awards. Basically, at our offsites annually, we have these awards for those who exemplify our values. We have 4 values that are near dear to our hearts, and we have this poll. It's like, who do you want to nominate for X Side Star Award? And funny enough, everyone's like Claude. Claude should get all the awards.
Funny.
And it's
Claude
true.
Code.
Like Claude Code for engineers is changing how they work, right? Pretty dramatically.
Yeah.
For me, I'll give you an example. Like, I'm going to fintech meetup in a couple of weeks, and I wanted to figure out who we should meet with. So I asked Claude to like go through the entire attendee list and find people who are interested in private markets or whatever. I got a list of 100 names. I was able to spend like 15 minutes versus like 6 hours looking through a bunch of names, right? So like, it's changing everything we do at a pretty fundamental level.
Yeah, that's incredible. Yeah. And so I feel like I've been thinking a lot about this existentially as a VC. What disappears first, you think? Kind of the growth stage, late stage venture capital? Or yeah. So you have 3 stages really. You have the early stage, the pre-seed seed stuff, and you can maybe put A in that bucket. And then you have the A, B, and C stuff. And then you have kind of the late stage stuff, right? If AI is like this superhuman ability to create and do things, where do you think, what do you think disappears? Because I feel like maybe we're seeing the last gasps of the late stage right now, this kind of frothy, like late stage stuff. You know what I mean? And maybe that sort of, or maybe it's more of everything. It's kind of just more of everything at every stage with AI in 5 years from now.
I don't think we even know yet. And I think people have a lot of opinions that are changing. To answer your question about what happens in venture, my personal view is that late stage it shifts from, hey, we're going to help companies raise capital that they need to keep growing, to we're a liquidity firm, right? We're buying out earlier investors and taking a position for the next growth wave.
Yeah, it's like a private stock market.
Yeah, basically.
Like a private market maker, a private Merrill Lynch, basically.
Exactly. And our view is that should take place through SPVs, right? As a perfect conduit for the underlying equity. I think we don't know yet, but there's going to be a lot of change for sure.
What do you think the SEC will do about these private companies staying private till $1 trillion? I mean, I don't think we've seen anything like that in the history of like capitalism. I mean, $1 trillion private companies is just insane. Yeah, we gotta let the retail guys in.
Yeah, it's happening. One of the things I didn't get to answer when you asked me about what's changing or what the world looks like, I think one of the big things that's changing is also the retailization of private markets, right? So you see companies like Robinhood launching like a private company fund, right? I think it launched this week or priced this week or whatever. We see a lot of retail demand flowing in through SPVs into late stage companies that are mature but haven't gone public yet. The incentives to go public are shifting out. Like you mentioned, you have $1 trillion private company, never has to go public, and maybe liquidities catered to through these late stage growth equity firms versus having to go public. There's a lot of stuff that's changing. I think ultimately the wealth still comes from the retail market. Now, the conduits through which it flows typically was like retail to public company, but now it's like retail to wealth advisor to like growth equity to liquidity, or maybe at some point retail to platform to liquidity, right, of a company directly. And I think that world's changing quickly. As far as what the SEC does to answer that first question, I don't know. But I read something this weekend about how the SEC is considering doing away with quarterly reporting of financials for public companies. So obviously regulatory easing is on the table. What does that mean for the private markets? I have no idea, but if we're seeing easing in the public markets, maybe we'll see some harmonization in the private markets where like larger private companies have to report some stuff, but not the same as a public company. Public company has to report less stuff. I have no idea where that's going to go. I really hope there is some guidance from the SEC on how to do the job of a fund manager that's syndicating secondary investments, because that is a place where you see all kinds of stuff today. And I think the market would really benefit from like guidance on management fees, guidance on carry, guidance on things for like being essentially a finder where people are acting as VCs, but kind of look like a finder. And that's a real issue today.
Right. Yeah, it's definitely out there. When you see exits on the platform, and I'm sure you've seen quite a few, what does the structure of that typically take? Is it mostly cash? Let's take an IPO. Is it mostly cash that the managers are distributing to LPs, or are you literally having to set up brokerage accounts, ship shares into people's accounts? Like typically, what's the mechanism that you typically see at Sidecar?
Typically for IPOs, it's in kind, because so in an IPO, if you were to just like sell everything, right, and distribute cash, you're potentially negatively impacting folks from a tax standpoint, right? That now have to realize a gain. Whereas if you in-kind distribute, there's no realizable gain. They can book it whenever they want.
That you already had.
Exactly, right? So typically we say in-kind. In the private M&A space, we're seeing a lot more cash deals these days. I think because the markets are a little healthier, frothier, whatever you want to call it. And there are certain businesses that are really like sexy, for lack of a better word. These are all cash deals. Previously, it was also in-kind, but we're seeing a lot more cash these days.
Yeah. What are you excited to build in the next year or two? What's on the roadmap that you're excited about?
I'm really excited for us to build for what I think of as our next growth wave, which is how wealth advisors are creating opportunities for private clients to invest in startup companies or other assets, whether it's through SPVs or feeder funds. We're seeing a lot more activity in this advisory world where people are getting asked by their clients for access to specific names or types of assets. And they're not having to put a hat on and think about the private markets more specifically than just shopping a list of large funds like the KKRs of the world and offering just that to their clients. And I think in that world, advisors need to be more educated on the private markets, understand some data and insights about what companies are doing in the private space. And there's an opportunity for Sidecar as a business to streamline the data and insights around what's happening in the private markets and offer the advisory clientele structure and services so they can start to direct place capital into private businesses. And that's something that I think will continue going forward.
Yeah. Yeah, you guys are uniquely suited right there because you see a pretty large swath of the market, I would imagine. So you have a lot of ground truth there. You know, what is the preferred share of, you know, name your favorite, you know, $1 trillion company like trading at? Like you have it, ground truth right there in a lot of your SPVs.
For sure. Yeah. And there's a lot of other people doing good work to create narratives around the businesses and otherwise collect data and help people understand what it means.
Well, let's wrap up some rapid fire questions. What's a operating or compliance mistake you see first time fund managers repeat that is completely avoidable or that you're able to make them avoid with your platform?
I kind of named the two that I thought of earlier. One is like mismanaging timelines with the founder and with your LPs and having like this like crunch, right? Around like, hey, people have to get everything done right now or we're going to lose the deal. Second being having to potentially register as an investment advisor because they didn't know what you were doing in the secondary space. And you could have figured it out had you asked some questions earlier.
Yeah. What's your strongest contrarian take about SPVs, syndicates, and or emerging managers?
SPVs take over the world. I think that SPVs eat a lot of traditional administration because incentives are aligned on a per asset basis and the retail market will increasingly want to participate in specific assets, not just broad baskets of assets.
I see a world where like for us, we started, it's in our name, Team Ignite, right? We started as a syndicate and that was always the vision. It's like, hey, let's build a large network and scale startups. And we were happy to do syndicates. But we noticed 3 problems with syndicates, and which is why we're glad we have like a blind pool of capital. One was we would get pushed out of rounds, right? Founders would want to syndicate. That doesn't always happen, but especially in early stage, it happened. Valuations would change, right? So we'd go, you know, raise the 100, 200K and go to wire to the founder and be like, oh, I know I told you a 10 cap. It's a 15 or 20 cap now. You're like, well, I just told all my LPs it's a 10 cap, you know? Oh, sorry, we're oversubscribed. So, you know, you took a few weeks, 3 or 4 weeks to get the money together. Now it's a 15, 20 cap. I was like, oh man, I could have had like a 2x markup if I had a fund. This happened a lot. Or the round would close, right? You know, the timeline thing, right? You go raise the money and like, we got to wire by Friday, you know, it's like, okay, it's Friday. Here's the money. Well, sorry, we closed the round. You know, we're oversubscribed, you know, we'll stay in touch. And so this stuff would happen a lot. So in early stage, it's really hard to run syndicates, I think. For pre-seed and seed companies, I just ran into this problem. I think it's a little easier with kind of series A and B and C, and especially the late stage, because you have a little bit more time. You know, it's like, hey, it's a priced round. You know, we are closing on this date. What are your thoughts on all that?
I think these are challenges that can be solved for with software and services. Let's take an example of fast moving deals, you know, having LPs either store capital to be ready to deploy, right? In some sort of like escrow or a wallet, right? Or a product that allows you to fund immediately and backfill with LP capital, right? These are things that can be solved for. It's not to say that blind pool funds don't still have a place. Like I think that if you as a manager have unfair access and, you know, this is a job that you want to do where you raise capital at regular intervals, but not continuously have to chase capital, there is still a really good job there for great managers to like pick, you know, diamonds in the rough. But I do think that's an increasingly
like if you don't have track record, then you should start with SPVs. 100%.
For sure. Yeah. And I think another thing is it's hard to raise blind pool funds, right? So I think it's going to be increasingly more difficult to raise blind pool funds.
Pretty hard.
Yeah.
The hardest thing ever.
So congrats to doing it. Most people don't.
2.5 years to raise fund 2. And I had a track record. I had 50 investments, had a bunch of markups. When I raised fund 2 back in 2022, it was just pulling teeth, man. Pulling teeth. I have a public fund 3, so I can talk about it publicly, and it's marked up. So it's like right at the end of the fundraise. I'm just like, hey, it's marked up. Do you guys want to invest? It's a lot easier. But yeah, it's one of the hardest things I've ever done, for sure.
Yeah. Because you're raising for Brian Bell, right? You're not raising for an asset.
Give me your money. I know what to do with it. It's
right.
hard.
Exactly. That's what you're asking for.
What do you think happens to venture if IPO timelines stay long and they keep getting longer and liquidity stays constrained?
I think we need to solve for liquidity if that happens. And I think that's what happens is liquidity in private markets becomes independent. It becomes like an independent asset in a sense that people are investing in more frequently.
Yeah. What's one thing regulators could do that would improve private market liquidity integrity without crushing innovation?
Provide some guidance on fees and carry in venture, especially in the secondary space where SPVs are often investing in other funds or SPVs.
Yeah, that's a good one. What do you think the best venture firms will do differently in 5 years compared to the last 5?
All of these answers are relating to each other. And it may sound like I'm not really being creative, Brian, but this is like the best VCs will understand that their LPs want liquidity. And there will be hopefully an emerging market for liquidity. So they will pass, instead of holding an asset forever, because companies will never go public, I think they will at regular intervals cater to liquidity and essentially recycle capital more or offer people a way to get their capital back more frequently than the current model of VC, which is just like hold for 15 years.
We're sitting on a bunch of unicorns or half unicorns in Fund 1, I should say. These are $400, $500, $600 million companies we invested in at 15 and 20 caps, right? So we're sitting on a bunch of 30, 40, 50x things in Fund 1. They're doing well.
Hell yeah.
And now we're starting to think like, okay, maybe, and I'd love to maybe put your LP hat on and we could just, brainstorm how to approach this. But because I'd probably run the SPV on your platforms. It's cash for you. But should I form an SPV and take that position? Should I tell the LPs in the fund, hey, we're going to liquidate the entire position and DPI the fund. You can now invest into this SPV if you want to stay along for the ride. Or what percentage of that unicorn should I try to DPI my entire fund, sell like maybe 50% of one of those positions or like 25% of all those positions? How do I think about that? That's something I'm starting to kind of, in fund year 4 or 5, I'm starting to kind of have this problem, which is a great problem to have.
I would talk to your biggest LPs and see what they want first and foremost. Like, because they may have a view. I would be surprised if they said, don't take anything off the table. I want to stay in this forever. Right. As a fund manager, I think it's actually in your incentive to take stuff off the table at regular intervals and maybe even return the fund, because that cash is presumably going to come back to you because you did good work, right? So it gives you a chance to deploy more capital on the other side.
Right. I 1x DPI'd this pre-seed fund after 4 years. Cool. And
if you more than 1x, you get some carry, right, on that, and then you get to redeploy.
Last question. What's one belief about how private markets should work that you're trying to make true through Sidecar?
I'd like to see the private markets look a lot more like the public markets in some ways that I really appreciate the public markets. Transparency, standardization in how information is reported, standardization in how structures are created and how people subscribe to them, which I think leads to more liquidity in the private markets, because transfers of like kind stuff is easier than transfers of like everything looks different, right?
Right.
So I'm excited to contribute to that.
Yeah, it's difficult because of all the different liqupref stacks and all the shares have different classes and different covenants and different side letters. And it is difficult, but it's something we can aspire to, which is something like a private stock market, right? Where if I want to go buy a share of OpenAI, right? I can go, to Sidecar and just see what's the list price, who's selling it. Cool, I can just buy that. That would be amazing. And I think it'd be really great for, and it's private, you have to pass accreditation and stuff like that because it is riskier than a public market transaction. But I think that would be really, really amazing for the private markets and for liquidity generally for employees and everybody.
For sure. Yeah, I think the confusion today is around, I don't know if like liqupref negotiations will change radically and how companies operate will still be pretty different from one another. But as far as what you hold indirectly, understanding what that value is today is opaque. I think that could be changed. So even if you're just buying a share of an SPV later, that it represents a certain real value of an asset and what the fee arrangements are along that train.
Awesome, Nik. Well, I really appreciate you coming on. Learned a lot. Thanks for all the work you do. Thanks for coming on.
Thanks, Brian.